Just spit it out. Yeah. Roller coaster. Okay, that's a great one. Who else? Surprises. 100%. What else? Come on, guys. What do we got? Sorry? Cold. Yeah, definitely cold. Today's ridiculously cold. Alco, come on. I see you're big and tall, so I get to pick on you. Fun. Oh, this guy, yeah, he's always having fun no matter what season. Yes. Crazy busy. Okay. Love to see what industry you're in. All right. Yeah, I mean, we nailed it on the head for the first one. I felt like this year was a roller coaster. We had those ups, we had those downs. You know, when you're on a roller coaster and you get those like that G feeling in your stomach, there was a couple moments where we had that. It was crazy. There were so many things that were happening. So how I'm going to break it up is there's 3 sections I'm going to talk about. There's going to be the first part, the middle part, and kind of the end of the year. What were the hot topics? Interest rates, 100%. So we have, I would say there's 2 hot topics that we had. We have interest rates and we have inflation. So obviously with interest rates, things were kind of normal in the beginning and things just went crazy. Things that we haven't seen for a very long time. Interest rates that, you know, I haven't seen in my lifetime or remember. And we saw it affect buyers. We saw it affect the market. We saw it affect a bunch of things for so many different types of people. And the second one was inflation. So gas prices. You remember back in 24 months ago when we saw gas prices below $1, floating around like 50, 60 cents a liter? That was unheard of. Then we saw those giant peaks. So we've been dealing with a huge thing of inflation, from groceries to chip shortages to gas prices, utility prices. All these things were affecting the market. So January to April, that's kind of the first half that we're going to talk about. I just remember COVID. I know, like, I kind of blocked it out of my head, but back in January, we were still dealing with COVID. Isn't that crazy? COVID was still a thing. We had restrictions. We had these mask mandates. We had we had vaccine passports. We had travel restrictions. All that stuff was still part of our world in January, the beginning of 2022. We had the Russian invasion of Ukraine. There were so many uncertainties at that time frame. We had humanitarian issues. We had uncertainties with global affairs, supply chains. And then we had a crazy real estate market. Things were nuts. We had a pent up amount of buyers. We had supply issues. There was multiple offer situations. I remember going out for showings, especially in some of like the bedroom communities of Sherwood Park and St. Albert, and you'd go, house would hit the market. You'd call a couple hours later after it hit the market, and there was no more showings. You couldn't even piggyback off of other agents to get into houses, multiple offer bids. Things were nuts. Being a buyer at that time was so challenging, but a seller, it was fantastic. So what were the strategies at that time frame? What were the things that we were looking for? Well, who's an investor in the room? Raise your hand. Okay, we got quite a few of you. We all have that one or maybe 2 dog in our portfolio. You know, the one that doesn't really cash flow the way we thought it would. The one that has some pretty, you know, okay tenants, repair and maintenance issues all over the place. We all have those. So our conversations with our sellers was sell those dogs. The opportunity for you to sell this property at this time, we knew that in January and February, if you can get into the market in a timely fashion, you have an opportunity that you're not going to see for a very long time. What do we do with our buyers? Well, good deals only. How many of you have ever purchased a property in a time frame where things were like crazy? 2008, 2014. Yeah, this guy, he knows. He knows. I remember like back in 2014 when I bought one of my first properties, it was everything was going up and you're like, I'm going to miss the boat. If I don't get on this, I'm going to miss this giant wave of opportunity. And it's scary. People want to get in there. But if you're educated and you have the right team, people can guide you through that so you don't get taken advantage. You don't miss the market. So don't be pushed into the craze and overpay. Don't get pushed into that multiple offer situation if you don't need to be. And in January and February, the strategy we also had was for flippers. This was a fantastic time for flippers to get in, get a property, kind of that early start of the year, do a quick renovation, some cosmetic things, and be able to get it on the market for peak season. We had some amazing flippers do some crazy numbers in that time frame of that first part of the year. May to August. Okay, COVID. Do you guys remember getting like a COVID thing in your nose? That was the worst. And it was, yeah, that was crazy times. But restrictions were lifted. Things were getting back to normal. People wanted to go on vacation. There was restrictions were ending. Things were finishing up. But remember our two hot topics of the year, inflation and interest rates. Those things were creeping up. Those things were starting to butt up. Really, we started to see that pick up in March. And what did we have? We had people just scared. They didn't know. They're waiting for some sort of stability, some sort of, crystal ball of what was happening. So what was the strategies? Well, this wasn't really a strategy, but when we were making phone calls, when we were talking to clients, majority of people were saying, I just want to wait and see. I don't want to pull the trigger. I don't really know. Everything was next interest rate hike. Where is it going to be? We didn't really know, especially for investors who have variable rate mortgages. They were unfamiliar with the territory that they're going to have. So they were scared about pulling the trigger on something else. So they were going to wait and see what was going to happen. There was a bunch of people who also had pre-approvals. When you were lucky enough to get all your documents in order, when your mortgage broker is hounding you to get the documents in, you could lock in an interest rate for 90, sometimes 120 days. So those people who had those interest rates locked in, they wanted to get a property before their interest rates would cease. So pre-approvals, taking advantage of that pre-approval and getting into the market before interest rates continue to go up. Look to find properties that were turnkey with existing rents, with existing tenants. So as we saw the interest rates to peak up, mortgages were more expensive. We had utilities going up. What happens to your cash flow? Our rents were unfortunately not going up as fast as inflation. They still haven't yet, but people were looking for properties that still cash flowed in the numbers that they were running at that time. So we had to look for properties that had existing tenants, properties where we knew we could increase the rents to try to get the most cash flowing type of property for those individuals. September to December. All right. What's this guy doing? He's holding his breath. He's waiting. He doesn't know what's going to happen. So, that's kind of what it felt like in that second half of that year to the end of that year, is a lot of people were just holding their breath. They didn't know what was going to happen. They still were just kind of waiting to see. And people who were pulling the trigger felt like they were rolling the dice because they just didn't know. Nobody really knew what was going to happen. But we moved into a balanced market. That's kind of where we're sitting today, is in a balanced market. That craze in that beginning, inventory came back. Buyers kind of got pushed out with interest rates going up and buying power coming down. So this is kind of where we're seeing what's happening right now. So what was the strategy at that point? And today, what are we seeing? So more focused on forced appreciation. So if someone who doesn't know what forced appreciation is, it's basically the ability to do some renovations to a property, increasing the value and to forcefully appreciate that property. That was huge. Put some sweat equity into it. That's always a term that people like to talk about. Cash flow. Sometimes looking for properties that don't fit every single checkbox that you would be looking for, you would sacrifice a little bit of location for cash flow. Cheaper price properties. Obviously, with interest rates going up and everything happening, people's buying power sank. They dropped. So we had to find properties in a different type of price point. MLI Select. Who's familiar with the MLI Select program? Awesome. Yes, we have quite a few people who know. So basically, MLI Select. This is through CMHC. So this is anything that's our 5 units and greater on the commercial side. And basically, what it is, quick cold note version, is you get points based on different parts of a property. So they're going to look at affordability, they're going to look at net zero, and they're going to look at accessibility. The more points you get, the better amortization. So the longer amortization you have, and the less down payment. So the better loan to value that you can get. So in some cases, you can get 5% down, so 95% loan to value with up to 50-year amortization. There's been a huge push. I haven't seen a conventional deal on the commercial side be done in a long time, because the MLI Select program is really good, and it's one of the ways to be able to get into a lot of these commercial properties. And creative strategies. Who was all here for the Barry and team agreement for sale workshop? Okay, so if you guys haven't seen that, on our YouTube channel, we have the agreement for sale recordings. Creative deals, they're happening all over. We have opportunities where sellers are having variable rate mortgages. Things are going up. Things are crazy. They need to get out. They want to get out. Breaking a mortgage, people don't want to do it. So being able to do an agreement for sale. On the commercial side, we're seeing a lot of assumable mortgages happening. I think Devin's in the front. There was a deal that went out. It was a 7-year term left on a mortgage at 1.8%. So that's crazy. There's deals out there to be had like that. That's what's happening in today right now. So this is the consumer price index. So if we take a look at when we were looking at the map, how things were increasing. So it was fairly steady in the beginning of the year, and then in March, things just really started to take off. Same thing with our interest rate hikes. So we really were steady until March, and then that's every single increase happened, and it went from 0.25 to 0.5. 1%, 0.75, and people were waiting for that stability. That's what everybody was waiting for. This is a really, really handy tool for anybody who wants it. So this is a great asset. So basically what this is a benchmark price. So they take a look at it and they give you a time frame and a property type. So what I've done, I'm not going to go through it too much, but basically we can send this to you guys after. But essentially what this is it takes a look at the benchmark price and it goes through the timeline. So 6 months was kind of the peak. 6 months ago was the peak that we saw. And I broke it down into part of the areas of the city where a lot of investors are targeting. The Bonnie Doon, the University, the West End, the North Side. And it sees how well it weathered the storm of the last 6 months, 12 months ago, 3 years, et cetera, et cetera. So this is a great resource to see if you're looking to invest in a part of the city, what areas are best. So this is the updated stats for November. So this is the most recent stats that we've seen. A couple of things to point out here. Take a look at our year-to-date sales. It's down 30% year over year. So that was from last November. So things were crazy back then. And obviously as we progressed into 2021, sales just maintained. Things were crazy. We look at the lower left half of the screen, we'll see the single family houses, condos, and duplex and row housing. If you look at the year over year average and median price points, they're going up. As we were talking about with interest rates going up and inflation, as buying power reduced, people had to find cheaper and cheaper properties to purchase because that's all they could afford. So that's what we're seeing in the market. And even when we look at our average days on market as well, that's kind of exactly what we're seeing from last year to this year. So conclusions. Don't be Will. Don't be Chris. You don't want to be caught with, saying some mean jokes about someone's wife. You don't get slapped and, not come back to Mogul Mastermind for 10 years or anything like that. But so real estate investing is not a get rich quick. Real estate investing is long-term. So you have to focus on the fundamentals. That's one of the most important things. Obviously, over the last 12 months, we've seen highs, we saw lows. It's that roller coaster. But if you focus on the fundamentals, you're going to be okay. And last but not least, it's always time in the market, not timing in the market. So it doesn't matter if you just bought at the peak, but if you extend that timeline, you have the ability to ride out those waves versus being scared at the peaks and being scared at the lows. Edmonton is a very steady Eddie investing city. So unlike